All right. Good morning, everybody. Welcome. Super excited for our 2024 market forecast with California Association of Realtors Deputy Chief Economist Oscar Way. You guys are in for a really big treat for today. My name is Anthony Volin. I've been in the real estate industry for 21 years. I was the 2022 president of Greater LA Association of Realtors and have been a director for California Association of Realtors for over 10 years now. And I'm just so grateful and for all the different opportunities that our industry has provided us, especially California Association of Realtors. They have so many amazing tools for us to use as realtors and so much support and do so much lobbying and work to help protect our business and our clients' investments. So special shout out and thank you to California Association of Realtors. I started the collective about 10 years ago, and I did it because, I don't know, I was seeing a lot of managers that just weren't quite as focused on the agents as I thought they needed to be. And, I was a manager at another company before, and at corporate, they give you so many different responsibilities that they demand that it's just really hard to make sure that the agents are the focus of the business and the company. So I started the collective about 10 years ago, and haven't looked back since. The mission at the collective is creating paths to wealth through real estate. And that goes for our agents. My mission is to help them grow wealth, and also for our clients and our real estate partners. And some of them are on the call as well. So welcome. One of the biggest ways that I found that I could help realtors create wealth is keeping more of their commission. So one structure we have set up here is making sure that when you sell about 3 to 4 million in real estate, you go to a 96% commission split. So I don't know if there's any other realtors out there who aren't happy with your split. Feel free to talk to me anytime. Um, one of the So another core value of the collective is education. And in this industry, you have to be on top of the market, on top of ways to build your business, on top of ways to give the customer service that your clients are expecting. And all of those things are changing all the time. So at the collective, we're so passionate about bringing education and seminars and workshops to our agents and to the public and to any agent at any company. We're always open and welcome for anyone to come in and listen. We just want to be that source of value providing to you to make sure that we're able to keep this industry alive and at the high level that it deserves to be. So today, we're super lucky, as I mentioned, to have Oscar Way, California Association of Realtors Deputy Chief Economist, with us. He probably understands the real estate market better than anyone in the state. So I was at the CAR Expo in, I think it was September, October, and that's usually when they first launched the 2024 market forecast. And so much has been changing so quickly since then that I thought, like, we need to have an updated version of this because the forecast has changed and I want to know what's happening right now. And I want to bring that to my agents and to our clients and to our friends. So thank you, Oscar, again, so much for being here today. If you truly want to give the highest level of service to your clients, you have to really understand these stats and these trends that Oscar is going to share with us today. This is one of the most important things that you have to understand so you have confidence in how are you going to be building wealth. You need to know the trends, what's happening, so you can guide your clients confidently to make sure that you're protecting them for what's to happen coming up in this year. So without further ado, I want to introduce Oscar Way. Take it over, sir.
Thank you, Anthony, for the introductions, and thank you for the shout out for CAR. We do have a lot of good products and good services that we provide. So thank you for mentioning that. And Anthony, you're absolutely right. There's a lot of information out there. There's a lot of information, ongoing information every single day that makes it a little hard to understand the housing market. So hopefully today, with my presentations, I have a slide deck that I'm going to show. Hopefully with that slide deck and with some of the statistics, we can make it a little bit easier to understand, what's going on with the market and what we can expect in the upcoming year. So let me share my screen. Give me 1 second. Here we go. And let me pull up my slides. Can you guys see my slide deck? Perfect. Perfect. So let's get started. Now I have about 60, 70 slides that I want to show. And I'm going to jump right into it and show you what the expectation or what we can expect in 2024. And as Anthony mentioned, yes, we had a forecast, we had a projections and that we did in October of last year. And things have changed, and we did make some changes to our forecast. Bottom line is very similar, though direction-wise it's similar. But things have changed as far as the economy, expectation about what the economy is going to be like, what the housing market is going to be like, and of course, the one of the main things that people look at in the last 2 years, 3 years is what's going to happen with interest rates. What's happening with inflation, what's going to happen with interest rates. So here are some bullet points highlight high level bullet points you can take a look at. The first section is about economic outlook. We believe the economy is going to continue to grow, and it's going to grow at actually a softer level than last year at 0.7% in 2024. Now, you probably have heard, in the last year and a half, many economists have talked about we are going into a recession. There is going to be a recession. It's going to be a mild recession, but we're going to recession. But it looks like, many economists, myself included, probably is a little bit off because we actually had a pretty strong fourth quarter last year. I'll go into a little bit more detail, but we do expect a softer 2024. And that's not only the economy itself, but the labor market as well. So the unemployment rate at a national level will probably reach a little bit over 4%, a little bit higher than what we saw last year. And of course, the very important element is inflation. What is going to happen with inflation? We did have inflation at 9% at one point in 2020, in 2022, it came down, and it's continued to slow down. We expect 2024, the number will continue to cool off a little bit, but it's not going to get to that 2.5% that the Federal Reserve want to get to. Now, it could actually get below 3%, but you will see that it's probably going to take a little bit more time. Now, what about the market? Now, inflation remaining a little sticky. We probably could see 30-year fixed rate staying a little elevated. I hate to say this, but the 3% interest rate that we saw, 30-year fixed rate that we saw 3 years ago, probably will not be around be here for the next 2, 3, 4 years. To be honest with you, I think that's a once of a lifetime thing. But we could get back to the norm that we have seen before. The norm in the past was 6.5, but we'll go down at some point below 6%. So we believe now the annual average last year, we had some fluctuation in 2023. We actually went all the way up to 8% before coming down, but the annual average was around 6.8 in 2023. We believe that annual average in 2024 will come down to 6.3%. Oh, I'm sorry, the 2023 was 6.8. We believe the annual average in 2024 will be somewhere around 6.3%. Now, it's probably going to start off with, right now, we're at, depending on what source you look at, we're probably at 30-year fixed rate somewhere around 6.8 right now. But by the end of the year, we believe it's probably going to approach 6%, maybe a little bit below 6%. But because of the stickiness of inflation, it probably won't go down too much. Now, I'll be happy to be wrong. If it goes down a little bit more, that'll be great. But at the same time, just based on what's going on, we're seeing some inflation being a little sticky, prices a little sticky. It might take a little bit more time. What is that level of interest rates going to happen to impact the sales and price? Sales wide at the state level, we believe existing single family home will improve. It will increase by about 27% in 2024. We actually upped that a little bit in terms of the percentage because of what happened at the end of last year. At the end of last year, we actually had very low sales, but we think that is going to improve. We believe that level is going to continue to improve in 2024. And at the same time, we also believe prices will also continue to inch up moderately, maybe by about 5 or 6%. And the reason why that is the case is because of tight supply. Anthony and everyone in the room probably know very, very tight supply in the last couple years. probably will continue to be tight, but there will be an improvement. We believe that supply will improve by 10 to 20% or so in 2024. Now, having all those bullet points in mind, let's go into the actual slides. Hopefully, with the slides, I'll be able to explain why we actually come to conclusion with those bullet points or those numbers. And at the end, I'll show you those numbers again, or actually in the middle, I'll show you the economic outlook. And then at the end, I'll show you the housing market outlook. And I'm also going to show you at the very last, with the last few slides, why there could be, some wild cards, some risks in 2024, and what are some of those risks. So let's get started. Let's take a look at the economy first. I promise you, of course, talking about economics could be a little boring. I promise you not to be too boring. I try to bring in some stuff, day-to-day stuff. Hopefully that'll make it a little bit more interesting. Now, let's first take a look at the economy. I said the economy at the end of last year was pretty strong, right? Well, many of us went out and buy stuff, right? If you look at, the MasterCard spending pulse, this is a survey that looks at how much people spend in terms of holiday spending, and between November 1st and December 24th. That's the period of time. That's the time frame that we typically spend and buy gifts for our friends, families. And it looks like if you look at, the 2023 versus 2022 number, most of them are actually a positive. That means we have been spending a little bit more compared to, what we spent in 2022. Now, I have to be honest, in the first section or in the first top line, that is a number that doesn't account for inflation, meaning, it's inflation, it's not adjusted for inflation. Let me put it this way. So with inflation at around 3 or 4%, it's not a surprise to see retail sales number actually increase. And so in terms of dollar amount, it actually increased. So at the end of last year, we were spending a little bit more online, we were spending a little bit more in store, and of course, we have been going to restaurants, we have been eating out, celebrating the holiday with our family and friends. And as such, the fourth quarter, the last couple months of last year, it was pretty decent. In fact, if you look at the fourth quarter number, yeah, we actually increased by 3.3%. What exactly is 3.3%? Let me just use the historical norm. I think in a normal economy, a 3% is considered okay. So with a 3.3% increase, that's actually a decent number. Now, if you compare that to the month ago or the quarter ago in the third quarter, it was actually pretty robust also. It was 4.9%. So, when people look at, well, 2024, it's actually not a bad year. We actually had a year of 2.5% growth, which is actually higher or better than, 2022. So, people might be thinking, well, what recessions are we talking about? We're seeing any recessions. And that's true. I think, the consumers actually have been spending a little bit more. They have been staying strong, partly because of the labor market being a little strong. I'll show you those slides later on. But in the third quarter, especially the 4.9% that I mentioned earlier, what happened in the third quarter? Remember, there were some concerts, right? I used to have a slide that shows what happened with the impact of Taylor Swift. I don't have that slide here, but hey, concerts, summer actually, generated a lot of revenue. Taylor Swift actually generated a lot of revenue, consumer spending. And the third quarter, fourth quarter together, it came down to a very, very strong, robust growth. Now, the December number came out also. You can see, I just want to show you this number. If you take away or take out that inflation number, it is still showing a growth. So the first section show you the retail sales number. That number, this 5.6%, that actually include inflation. But if you want to take out inflation, take a look at this real retail sales number at the very towards the bottom, 4.9%. It shows that we're still growing at a decent amount. Is that about right? Are economists wrong, or what is it? Why are people still thinking that we have a recession? Well, typically, I think when we go into the year 2023, we believe a lot of savings actually has been drawn. Consumers have to actually slow down in terms of consumer spending, and that's actually true. But at the same time, it's also true that if you look at the wage growth, I don't have the wage growth number here, but I'll show you those numbers later. Wages actually continue to improve because of a tight labor market. And at the same time, even though inflation continued to flare up, people's purchasing power, consumer purchasing power, if you look at this chart, this orange line right here, that's the inflation number, the consumer number. At the end of last year, it was increasing by about 3.1%. But take a look at those wage growth, those consumer purchasing power for each and every single wage segment. They're above that CPI number. So wage growth continue to help the consumers to continue to spend. And that's the reason why at the end of last year, we continue to see some improvement, solid growth in spending. Now, I have to be honest though, some of those spending, they were probably, a lot of people, and myself included, probably use credit cards. There were a lot of people, an increased number of people who actually use the buy now and pay later financing options. So at the beginning of this year, and maybe going into the second quarter, we may actually see some slowdown in spending. And that's why I think in 2024, we will see some slowdown in consumer spending. A 0.7% growth right now. We may actually up that, growth, economic growth a little later. But as of now, we believe that it's going to be a soft growth. And of course, it could change. But if you take a look at the labor market also suggests that things are actually cooling a little bit. Now, right now, if you just look at the past 3 months, things seem like it's actually doing better. In fact, in the last month of the December of last year, the expectation was job opening about 175,000 and 180,000. But take a look at this last line right here. The job number actually came in a little stronger, 215,000 gain in jobs in December, higher than that 175, 180,000 expected by economists. So top expectation. But if you look at the entire history, or not entire history, but the last 2 years or so, in general, we're seeing a cooling down in the labor market. Last year, 2022, there were about 4.3 million jobs gained for the year as a whole in 2022. But in 2023, that number dropped down to 2.7. So we know that it's cooling down, and it's expected to cool down even further in 2024. And that's why we believe the labor market is cooling, and it could actually affect the economy. Now, the other part of it that we pay a lot of attention to is whether wages are growing very fast. If wages are growing too fast, that is going to affect inflation, because if wages are high, people or employers, they have to actually raise prices to make up for the increase in wages, right? Wages, if you look at this dark red line, it had been once at the beginning of 2022, it was growing at 6%, close to 6% or so. Now you can see that it's continued to decline, steadily declining, but it's still growing at around 4.1%. That's a number that's continued to outpace inflation. But that number will continue to decline. And that's the reason why, with that number, the Federal Reserve actually think, inflation is coming down. But let's look at the inflation number and see if it's actually coming down. Now, if you look at this dark line, this dark blue line right here, that's the headline inflation number. That's the number that at one point hit 9%, or 8.9% to be exact, and then it started declining. At the beginning of at the end of 2023, it came down to 3.4%. Not too bad, but you can also see that it dropped and then it bounced back. So we did have some bounce back at the end of last year, but it's going to stay at around 3.4-ish or so, maybe below 3%, maybe in a couple months or so. It's going to be a little sticky though throughout 2024, but it will come down. Maybe not as fast as what we are seeing here in this declining rate. Now, the other line, which is the gray line, is what the Federal Reserve paid the most attention to, which is the core CPI. The core CPI number is the inflation number that takes away the more volatile item like energy and food prices. That number, they would like to get it down to 2.5% or so. I'll explain in a minute whether we are going to get to 2.5% and how soon we can get to 2.5%. But look at all these different items on the right-hand side. Some of these items continue to increase. Your insurance, your auto insurance continue to increase quite significantly. Some of the food items continue to increase quite significantly, or moderately, I should say. But there are items also declining as far as airfares come down. Some of you may be traveling before the summer of this year. You can probably get some deals. Um, my sister-in-law, she's going to Europe. She got some really good deals. If you look at gasoline, has come down. Now, I have to be a little cautious though. Gasoline could actually start coming back up a little bit because of the political turmoil, geopolitical tension in the Middle East. It is possible that we might have some comeback in terms of oil price, in terms of supply, and that could actually lead to increase in gasoline prices. Egg prices have come down. There are some other items that have come down as well. Used car came down a little bit. I'm about to sell my car, so I'm a little bummed that the car prices have come down, but in general, things actually are slowing down a little bit, which is good for the economy. But at the same time, how fast is this coming down? Here's the questions. Here are the actual numbers. The bars in blue, those are actual numbers. The bars in red, those are projections. These are projections from UCLA. So the projection on a quarterly basis, each bar is a single quarter. This is all going all the way to the fourth quarter of 2025. If you look at this headline number, it doesn't look like we are going to get to 2.5% or 2.5% even by the end of 2025. So it is going to take some time to get to that pre-pandemic level that the Federal Reserve won. If you look at the core CPI, it's even a little higher at 2.9%. So that's the reason why I think inflation is going to be a little sticky. The prices are going to continue to stay up a little longer. Now, that's the UCLA predictions. For consumers, if you look at the right-hand side, consumers have some expectation. Their price expectations, they have some expectation about what prices are going to be like a year from now, and then they make some assessment on, should I ask for higher wages, or what should I do when I talk to my boss? So take a look at that 1-year inflation expectation that was just recorded at the end of last year. In December, for December, the consumers in general expect a year from now, their price is going to increase. Overall price level is going to increase by 3%. Pretty in line with the current expectation or current inflation number. 3% is not bad, but the more important part of it is they actually have been trending down. Consumers are actually expecting a smaller inflation number compared to previous months and the last couple of years, which is great because that means if they expect less, they probably will be okay to settle with a smaller wage increase. In that sense, they are probably going to have the inflation expectation is going to be a little bit lower, and then the overall price level will probably be a little lower in the next 12 months or so. It's like a self-fulfilling prophecy. If they actually expect lower, most likely the inflation number will likely be lower. Now, of course, there are some other exogenous factors. There are some other variables that cannot be controlled. If that happens, then of course it will actually push up inflation. But so far, consumers have pretty positive expectations, not only on just inflation. If you look at their index, the Consumer Confidence Index, this is something that get released every month. And consumers, if the higher the number, the more confident consumers are. Take a look at this last few months or so. In fact, consumers have been increasing their confidence in the last 3 months. It's been increasing. Maybe because of interest rates started coming down, maybe because of the stock market doing pretty well at the end of last year. It was down just today, but it actually came back up. It actually has been rising, but it came down a little bit today because of many different reasons. But in general, consumers have been building confidence. They're feeling a little bit better, maybe because of the labor market doing a little bit better as well. So the expectation, there are two components here. The expectation part of it, the component, also suggests that consumers are feeling a little bit more confident compared to the previous month. So overall, things are actually doing a little bit better. What about business leaders? Business leaders, CEOs, they of course they have to try to figure out, whether things are actually going to do better or not in the next 6 months or in the next year or so, right? So the same Institute Conference Board asked CEOs, business leaders similar questions. They asked, though, whether business leaders believe we are going to see a recession. And if you look at this chart right here on this right-hand side, these are quarterly numbers. These are the number of people, percent of respondents who believe we will get into a recession in the next 12 to 18 months. Now you can see that that number continued to rise until maybe the second quarter of last year. Then it started dipping. So the latest number, the fourth quarter number, suggests that 69% believe that we will see a shallow U.S. recession, and 3% believe we're seeing a steep recession. Now it's still a 72%, so it's still a high number. But if you look at how it compares to, say, 4 quarters ago, it was 85% plus 13%. Basically, everyone believed that back then that we were going to recessions, but of course, the numbers still show that we're okay. I think more and more people believe that we're all going to see a soft landing. And if you look at earning calls, if you pay attention to the financial market, you look at earning calls. 4 or 5 quarters ago, in the second quarter of 2022, there were a lot of earning calls citing, oh, there could be a recession. Take a look at what happened. The number of calls that cite recessions continue to decline. Recently, in the second quarter or third quarter of 2023, the number came down quite a bit. So corporate America have not been talking about recessions as much as before. So these are the numbers that I showed earlier in the bullet points that suggest, based on what I just showed you, yes, GDP or economic growth, it will come down. It will be soft. It will be softer, and probably the softest in the last 4 years, but it will continue to be a positive. As far as unemployment goes, it is a little bit high compared to last year and the year before, but it will be below the 2020 and 2021 level. The inflation number, the CPI number, that number actually dipped to 2.6% in 2024 for the annual average. And as I mentioned earlier, I think there's a possibility of hitting 2.5 in 2025, but probably not in 2024. And what about the California market? Give me 1 second. What about the California economy? It is also going to grow. It's going to improve by 0.5%, and unemployment will actually inch up to 5%, which is not too bad comparing what we had in 2020 and 2021. It's not bad. It's inch up from last year though. So the economy is going to have a decent but mild growth rate. And how is that going to affect the market? Now, of course, if the economy is too robust, it's not going to have it's going to have an impact on interest rates, because the interest rate will probably continue to stay at a high level. But what if the economy is actually slowing down? It's increasing slightly, but not robust. Well, let's take a look. First, a snapshot of what happened at the end of last year, just to give you some background information in the next few slides. Well, it's probably an understatement to say, well, last year was not great. It's probably we probably should say, it's a tough year in 2023. It was not a great year in 2022 as well. So after a down year in 2022 and another year in 2023, we do expect things to actually improve in 2024. Now, if you look at the year as a whole, which is that YTD number, the year-to-date number through December, we had a 25%, a close to 25% drop in sales in 2023. For the month of December, though, it's still down, but it's actually down, not as much as before. Things are actually looking a little bit better, but it's still a soft beginning for 2024. Anecdotally, I have already heard from many members that things seems to be, we seem to have a little bit more activity at the beginning of this year. And hopefully that's very true. And then it will continue on in the next coming months or so. Now, as far as price is concerned, take a look at sales. So take a look at median price. This is the statewide median price. The statewide median price actually show a moderate increase of close to 6.5%. This and in fact, when you look at year over year percent change, it has been changed. It has been increasing on a year over year basis for the last 6 months or so. Now, some of you probably were in the market in 2007, 2008. You probably remember it was pretty bad. In 2008, we had prices coming down 50% or so. And at the beginning of the pandemic, people were thinking, well, the market is going to look like, what happened in 2007, 2008. But of course it didn't. It continued to actually increase in price. And even with the last couple of years, in 2023, as a whole, we actually dipped slightly. But we probably will see a bounce back in 2024. In fact, we probably will see a record high number in 2024. And the reason why that is the case is because of tight supply. Supply has been tight for the last 10 years or so. And the last year or so, it's actually has been even tighter because of what we call the lock-in effect, we will talk about shortly. But it remained at a tight level that continue to put some upward pressure on prices. Now, in a way, with prices, even though sales dip, but prices remaining at a moderate growth rate, it suggests to many buyers that, oh, it looks like, we are not seeing a lot of foreclosures, REO, and all those properties. And that's because people actually put in a little bit more down payment than before. Many buyers actually put in a little bit more down payment compared to what we saw in 2007, 2008. And that's why we're not seeing all those foreclosures. And that's why we're not seeing a price decline. In fact, the moderate price decline will continue at 5 or 6%. That hopefully will give buyers some confidence about, okay, well, the market is not dropping as far as prices. Let's see, if we can get a interest rates that works for us and then get back into the market. Now, if you look at it by price segment, you can see the higher end market, at least at the end of last year, seems to be doing a little bit better. The higher end meaning 1 to 2 million, 2 million plus seems to be doing a little bit better in terms of sales. That's probably because of interest rates may have play a role, maybe because of tight supply in affordable segments. The affordable segments seems to be a little tighter in terms of supply, but it still comes down to about interest rates, right? What is the interest rate right now? I think at the yesterday when I look at this is a chart that shows you two lines of data. What the orange one is the Freddie Mac's number. And the blue line, that's the Mortgage News Daily number. The Mortgage News Daily number, I look at it on a regular basis because it's something available on a daily basis. If you look at that number, for example, at one point, that 30-year fixed rate did peak at around 8%. But you can also see in the last couple months or so, started coming down. In fact, since mid-October, it started coming down. And at the end of last year, I think it dipped slightly, and then in the last couple of weeks, in the first 2 weeks of January, it started coming back, as I mentioned, because of strong economic reports. And in the last couple of weeks, it's actually started stabilizing a little bit. Now, this morning, I just checked the Federal Reserve announcement. They're holding the rate steady this morning. Now, the next meeting will be March, and then the meeting after that will be May. People have been speculating what's going to happen. I'll show you what some of the speculation might be. Now, of course, things could change in a matter of seconds based on the Federal Reserve announcement. But I haven't had a chance to look at all those narrative yet. But I'll show you those what the market believe is going to happen before the announcement. So now, before we go into that, let's take a look at the interest rates effect on mortgage payment. When we have interest rates going up and down, it changes the mortgage payment, right? This chart shows you what happened with an increase in 50 basis point in interest rates, how mortgage payment changes, and we put in some assumptions. We used a third quarter median price, 843,000. We expect people to put down 20% down payment. So what happened when we have a change in 50 basis point? Let's say from 650 to 7, we have a change of about $240. It matters for some buyers, for first-time buyers specifically. $240 a month extra is not easy for some of the first-time buyers. Now that is only 50 basis point increase. If we have a change from 450, or 5 to 7, that's like a $900 every month. Now, at the same time, when you look at that increase, you can also look at what if rates actually start declining. That means the mortgage payment could actually decline. A 50 basis point decrease could be 200. A 100 basis point decrease could be about 400 or 500 every single month. So if we start seeing decline in rates, things are going to look a little bit better in terms of sales, in terms of price, probably still going to show moderate increase in price. I don't think we will see 10-15% increase in price this year, depending on, of course, the area. But at the state level, probably not that much. Now you can see on the right-hand side here, the mortgage payment growth. On a month-to-month basis, in December, for example, we still had maybe about 6 or 7% increase in mortgage payment compared to the previous year. But I do believe that in the upcoming months, once rates started slowing down and coming down, let's say by mid of this year, we probably will see the number actually flatten out, or maybe even showing just a zero number, or maybe a 2 to 3% increase. Hopefully that is the case, because that means things are actually a little bit more affordable. Now I want to show you some survey results. Some of you have participated in our surveys. This is a survey that we do every second quarter of each year, and we ask the last transactions of our members, and they put in some information. Now, you can see the difference between 2021 and 2023, for example, what the mortgage payment difference is. Because of increase in interest rates and slight increase in price, look at the difference in interest rate. It jumped from 2,000 to 3,400, and that's the reason why we have some slowdown in sales. And people are paying a higher down payment as well. So it's making it's a little tough for buyers in the last couple of years, but hopefully things will change. Now, the other part of it now, first-time buyers actually makes up a big part of the overall market. First-time buyers in 2023 actually made up about 36%. That's pretty significant, and that's why it is important to help out first-time buyers, repeat buyers, and all type of buyers. But first-time buyers make up a very, very big chunk of the market, and of course, there are programs out there that help first-time buyers. But having properties at properties that are more affordable, being at a very low level, makes it a little tough for first-time buyers. Now, here's the same chart that I show you for all buyers, but this time it's for first-time buyers. You can see that first-time buyers also increased significantly between 2021 and 2023, the mortgage payment. So and of course, for their household income also increased from 110 to 120. So they need a little bit more household income in order to afford to buy a home. So it's needless to say, they probably need a little bit more help. First-time buyers probably need a little bit more help financially from their parents. If you look at this numbers, these charts, these bars numbers right here, it shows you the percent of buyers who actually receive financial assistance from their parents to purchase a home. 16%, a slight increase from the year before, but 16% of the buyers actually received financial assistance from parents and to purchase a home. Depending on what generation you're in, for first-time buyers specifically, they actually need 34%. 34% of them actually need assistance. And the younger buyers also need some assistance as well. So with the market actually, hopefully, with rates coming down, hopefully things will get a little bit better. Now let's turn our attention to some of the other segments of the market. There's the vacation home market. Vacation home buyers typically are buyers who are willing to buy a second home, which means they probably have a little bit more money. If you look at the second home market, the share actually has increased actually to the highest that we have seen for at least the last 20 years or so. So a lot of vacation home buyers are buying in 2023. We probably will see maybe a smaller share in 2024, but still at a high level. What about investment buyers? Investment buyers who purchase a property to flip or rent. We saw that number, investment rental properties actually dipped to 11% in 2023. I think it was 14% in 2022. But part of the reason could be the rental market being a little saturated. There have been a lot of multifamily homes coming onto the market, and that's the reason why we're seeing some of the investor shares dipping a little bit. But of course, at the same time, interest rates being high, prices actually inch up a little bit, could be another reason. International buyers. Um, International buyers, it's not a big share, but it typically makes up about 4 to 5% of the market. And we saw a little bit of slowdown in 2020 because of COVID, but it actually started coming back up. I think in 2024, it will probably remain at around 4%, 4.5% or so in 2024. Now, but the main part of it is still about supply. Supply has been an issue. We have been seeing tight supply for the last, well, for years. But the last couple years, we actually have been seeing very, very tight supply. And the reason is because of what I said earlier, the lock-in effect. I'll show you that slide in a minute. But take a look at this survey results again. People are holding on to their property a little longer. If you look at the number of years people own a property before selling, that number surged to 12 years. And that's the highest that we have seen in at least the last 20 some years, 23 years. And demographic could be a reason, but the interest rate being high could be another reason. I'm going to skip this one. If you look at this particular set of survey results, we asked homeowners, we said, what is the reason that holding you back on selling a home? And the very top reason is mortgage rates on another home would be too high. Remember, many of the sellers are also buyers. Let me go back to this one. Sellers who plan to buy, 48%. So there are quite a bit of sellers who plan to buy again, and that's why they need to be able to find a rate that works for them. And this is the lock-in effect slide. This slide shows you going back to 2013 in the last 10 years, what the breakdown of the outstanding mortgages is based on mortgage rates. So for example, in 2013, the first quarter, 27% or 27.3% of all the outstanding mortgages have a rate 6% and higher. Same for, if you look at the yellow section, that's the percent of mortgages or outstanding mortgages with a rates between 5 to 6. But fast forward 10 years from 2013, you can see there are a lot fewer mortgages with 6% or higher. And many people lock in their rate at 3%, 3.5% or so, and they're unwilling to put their house up on the market when rates are at 7%, 7.5%. But rates are coming down, so that's going to help. That's going to help in an upcoming year. First, of course, I want to show you this, that new active listing did drop quite a bit. But the positive spin is, the silver lining is, even though, yes, we have been dropping for 18 months, look at the drop. It actually has been declining smaller and smaller. In the upcoming months, or the January's number, we believe the new active listing numbers could be actually a positive, meaning we start seeing some improvement. I think anecdotally, again, I've heard more activities right now in the market. So that hopefully could mean that we're seeing more properties being put up on the market. That means more availability for buyers. Hopefully, it will actually means more sales, and at the same time, a more healthy market. Now, if you look at the price, home prices, I showed you this before. It's actually at the end of last year, it continued to increase moderately by 6.5%. In the next few months or so, it will probably continue to improve. Hopefully, with rates stabilizing or even going down a little bit more, then we can see some stabilization of home prices as well. Now, just like breaking it up by price segments in the sales, we want to take a look at the individual segment for price growth. This is we had this broken out into the 20th segment, 20th% segment. So this is the highest price point from 80th to 100th percentile. In dollar term, probably that will be somewhere around $1.5 million home and above. And you can see the price growth in the higher price segments seems like it's higher than the more affordable segment. So the high-end segments, they seem to be doing a little bit better in terms of not just in terms of sales, but also in terms of price growth. And if you look at the median price growth, it looks like certain areas are doing better than other areas. In Southern California specifically, we are seeing a 6.3% increase in median price, similar to the state level. Now let's take a look at some regional numbers, and then we'll use the next 10 minutes or so to talk about some of the wild cards, or the outlook, I should say. Southern California, similar to the LA, similar to the state, dipping at 6.2%, but for the year as a whole, dipping about 23% for 2023. So very similar to the state, but price-wise, also increased by about 6% or so. If you look at these other indicators, tight supply at 2.6 months, and the median days in market about 3 weeks or so. Here are some charts in the next 3 slides. This one included shows you county level data. LA County, which I highlighted here, increase in sales for December, a decline of 5.1%, but for the year as a whole, a dip of 21.5%. You can take a look at the rest of the counties right here. What about price? Price, every single county increased in price, and Orange County actually increased quite a bit, 15% at the end of last year. But the other counties also increased at around 5 or 6%. Active listings at the end of last year dipped across the board, except for Riverside and San Bernardino. But I think, again, new active listings probably will improve. Now, the next 4 slides or so, or 2 slides or so, those are city level slides. You can actually get some of the other cities from our CRL website. If you go to the Industry 360, if you go to the CRL website, go to Industry 360, and you can find the market data in the market data section, some city level data. So you can find these slides in there. It shows you a snapshot of the city level data of median price. Now this is December 2023 year to date. This is actually the whole year. So you feel free to take a look at these numbers. I'm not going to elaborate too much on the city level data, but feel free to take a look at it. I have LA and West Hollywood, and you can find some other cities as well. So let's take a look at what we can expect in the housing market in 2023, or 2024, sorry. First, housing market sentiment makes a big difference. If the consumer feels positive about the market, that actually could help the market to continue to move forward or move in positive directions. So look at the purchasing sentiment. This is a survey done by Fannie Mae. They release it every month. And they ask a question whether people believe it's a good time to buy. We dipped all the way to 14%, meaning only 14% believe it's a good time to buy. But look, in the last month or so, it started coming back up. So the sentiment actually improved at the end of last year. And the reason why? They also ask in a survey whether consumers believe rates will go down. Take a look at the blue dots right here. The number actually started rising towards the end of the year. In fact, it went from 16% to 22% in November, and then it surged all the way up to 31% at the end of last year. That's the highest surge on record. So consumers believe rates are going to go down. I believe rates are going to go down. You believe rates are going to go down, but the question is how much, right? And some of the buyers are also losing patience, and so they're going to jump back into the market. In April of last year, 85% of the prospective buyers are going to they held off and they decided, okay, well, I'm going to wait for prices and rates to come down first. But fast forward 6 months later in October, only 62%, and quote unquote only, this is still more than half. 62% homebuyers wait until prices and interest rates to start to fall before joining the market. But it shows that they are losing their patience. Some of the life changing event happens and they have to move on, right? So you will see that things are actually going to get more people are going to go back into the market if rates start coming down or even stabilizing. And I showed you this chart before. Inflation are going to stick at around 2.5% or maybe even higher. So what's going to happen if we have consumer price index or inflation at 2.5%, 2.7%? What is going to happen? So I went back to 1972. I look at, okay, so if we have an inflation at 2.5%, what is interest rates going to look like? So here are some a few errors, a few time frame that I actually check out and saw that CPI or Consumer Price Index at 2.6%, 2.67%, and 2.4%. At those time, the 30-year fixed rate average in 1994 was 8.4. 2004, it was 5.8. And in 2018, when CPI was at 2.4, it was 4.5. Now, it's fluctuated a little bit, but I believe if you look at, this is probably a more accurate measure. I believe the number is probably going to be somewhere between this number and this number, which means we probably will see if we actually reach 2.5 or even 2.6, we probably will see interest rate at somewhere around 5.5, 5.75 or so. It's hard to believe that we're not going to get back to 3, but the reality is we probably are not going to get back to 3%. Now, the Federal Reserve, before today's announcement, the last announcement in December, they offer some clue as to how many rate cuts they're going to have in 2024. Now, keep in mind the rate cuts means the Federal Reserve rate cuts, the Fed funds rate cuts, meaning the policy rate cuts. It could have an impact on mortgage rates, but it's not a direct impact. It's the expectation that's usually affect the mortgage rates. But what are the Federal Reserve planning on doing? Now, take a look at 2023 number and 2023. These numbers are basically their votes on what they believe the year-end number is. So in 2023, at the year-end, everyone, of course, this is already an actual number. So the number was 5.375-ish or so. The range is actually 5.25 to 5.5. So you take an average, 5.375 or so. And if you want to know how many times or how much rates will actually cut based on the Federal Reserve expectation, take a look at 2024 numbers. 2024 numbers, the midpoint is about 4.675-ish or so. So this suggests to us that the Federal Reserve believe that they're going to cut rates by about 75 basis points, at least in December. But the more important message here also is, take a look at this red line. This suggests that they will continue the federal officials believe that rates will continue to go down in 2025 and in 2026. Now that's, again, I want to emphasize that this is the Fed funds rate. Mortgage rates typically have a similar trending pattern, but that suggests the Federal Reserve will do this and the rates will continue to come down. So I wouldn't necessarily say that will come down significantly like what I told you before, like what I said before. If it actually ended at 2.5, probably will bottom out at around 5.25, 5.5, maybe even 5.75. So I wouldn't bet on the fact that it will go down to 3% again for 30-year fixed rate. But But what is the odd? Now, this number, they have already made an announcement, so this is probably outdated. But what are the numbers? What are the what is the probability? What is the chance that the in a next meeting they're going to cut rates? Now, first, the announcement that was just made about a half an hour ago or an hour ago was they're going to stick with the same policy rate, which is this range, 525 to 550. And the market actually guessed it, for the most part, it guessed it right. 94% chance that it's going to stick at this rate. So fast forward, let's take a look at what happened with March and May. There is a 60% chance that they will cut 25 basis point. Look at the number, 525, 500. So they would actually cut it down to 25 basis point, 60% chance. But there's also a 40% chance or close to 40% chance that they will actually stick with the same rate. What about May? May, I think there is a better chance. If you look at this target range, only 4% chance that they will stick at that range, but there's a chance that they'll cut it down to 40% chance that they'll cut it by 25 basis point, and then another 50% chance that they will actually get to this level. So by May, I think for the most part, the probability is rates will actually be a little lower as far as the Fed funds rate is concerned. Now, the market actually has been reacting, and you've seen this probably in the mortgage applications and some of the activities in your brokerage, Anthony, that we are seeing a little bit more activities as far as pending sales is concerned. I think at the beginning of this year, we might be seeing a little bit more activities for the last few weeks or so. This chart shows you that pending sales actually continued to decline at the year end of last year, but it's actually gotten to a very low level. And then price. What about price? Price-wise, if you look at the listing price, that's probably a good indicator of what's going to happen with price overall. It shows a positive number, and usually that's a leading indicator. That actually shows what's going to happen with sold price. That means in the next couple months, we'll see positive increase in price, at least at the state level. So, and supply. Unfortunately, last month, seller sentiment continued to be kind of weak. If you look at this red line, bad time to sell, that number continued to increase at the end of last year. So sellers may still feel a little sour, but hopefully things would change. This I showed you before. The reason why I want to show you again is, again, mortgage rates declining probably will help. So because remember, that's the number one factors that people are not selling. So with mortgage rate declining, they probably will see a little bit more inventory coming on board. And here's our expectations for the California housing market. And Anthony, give me a few more minutes to give you the wild cards and the risks, and I'll be done. If you take a look at, thank you. If you take a look at this last column right here, that's our projection. As I mentioned, 27% increase in sales. And as far as price is concerned, close to 6%. And this is the annual average for 30-year fixed rate. It will drop from 6.8 to 6.3. If you want to know the year-end number, I believe the year-end number, I mean, I mentioned it before, but the year-end number by December, we may actually get to 6% or maybe 5.75, but I wouldn't go lower than that. I'm being a little conservative. Maybe it will go down a little bit more, but the average 30-year fixed rate probably will be at the high 5. Now, there are wild cards. There are some risks that could actually change things, and that could affect the market. First, this is not new. You probably already know insurance is tough. It has been a tough housing market because of some of the insurance company withdrawing from California. And so last year we asked, our members, how many buyers actually had difficulty obtaining insurance? Overall, 17%. But if you look at individual areas, some areas are a little bit tougher than others. In the more rural areas, 32% have difficulty obtaining insurance. that could affect the housing market. And the reason why they had difficulty, look at the chart right here, and maybe the verbiage as well. 37% who had difficulty obtaining insurance said the premium's too high. And then the other 28% insurance denial. Got denied. They couldn't get insurance at all. Now, things could actually get a little bit better. I think this year, I think there had been some discussions about insurance companies staying in California. They might actually increase premium a little bit overall, but not necessarily just to new. So there's a possibility that we will have more insurance availability, but at the same time, premium could actually go up for many people. Now, we also have about 7% who were not able to buy insurance and completely dropped out. And that's the reason why I said these are wild cards. Now, there are some other wild cards. Economic impact. We already know what a couple weeks ago we had a government shutdown. We had a possibility of a government shutdown. We avoided it, but then it was kicked down. The can get kicked down the road, and then we could have another possibility of a government shutdown in March. And if that happens, that could affect thousands of government employees, and that could actually lead to also some delay in processing some of the mortgage applications, since some of the programs, the government programs, may actually have to slow down or shut down. So it does have an impact. I do believe that the government shutdown is the possibility of a government shutdown is very slim, and eventually it'll have to be resolved. The other higher a big risk that could possibly have a bigger impact is the commercial real estate mortgages. Many of the commercial mortgages, the CRE mortgages, were due last year and maybe due this year to be refinanced. Some of those mortgages will be matured, and they were locked in. Some of those mortgages were locked in at a rate at much lower rate than what we're seeing now. If those need to be refinanced, that means many of the owners of those properties will have to come up with a bigger payment. Now, some of those may actually decide to go default. So far, we haven't seen a whole lot, but if they do, then it's going to affect some of the local banks, the regional banks, who are they are the one who actually have been holding on many of those fundings. So if that's the case, that could affect the residential funding. So keep that in mind. This is a survey done by Mortgage Bankers Association, and they ask lenders or people in the CRE market how unsettling the situation is. Now, in the first quarter, it could be the most unsettling quarter. Things are going to get better as we move to the towards the end of the year, but this is something to keep an eye on. And of course, this is an election year. People ask us before, and we used the same slides before. In an election year, do we have any anomaly? Do we have any? Are we going to see a negative impact or a positive impact? Now, typically, so here's a chart that shows you the sales growth by month. What you want to see is whether things actually change in an election year versus the darker bar, the overall, which includes election years. Now, what you want to focus on is not necessarily the degree or how big the bar is, but the direction. If you look at the direction of each month, now at the beginning of the year, usually we see a year-over-year growth in sales in any year going back to 1990. And towards the end, we see some slowdown in terms of sales. In an election year, things actually is a little different. In the first half or the first 8 months or so, or 7 months or so, they go in the same direction as a normal year. But then at the end of the year, things seems to pick up. That suggests to us that sales growth tend to be a little stronger in an election year towards the end. So it is possible that people might have, but in the first 9 months or so, they're focusing on the election, and then they start, they see things actually start calming down, they start going back to the market. So at the end of this year, we probably will see, if it follows a similar trend, we could see a better sales growth compared to previous years. Price growth is actually a little similar also. They're pretty in line with a normal year, comparing the blue square versus the red triangle. They're actually trending in the same directions, about the same, but towards the end of the year, things actually start speeding up. So in an election year, it's positive price growth and positive sales growth towards the end of the year. Hopefully that will be the case, and then we'll see, a little bit more growth at the end of the year. Now, here's the wrap up. I know I used up the entire hour, and I apologize for speaking a little too much, but here's the wrap up. Here's the key takeaways. Inflation, it's easing. We're getting better, but it will not go back to the pre-pandemic level until maybe after 2025. But rates have already peaked. It should be over. We should actually start seeing slow down. Some rates start coming down, but I'm going to say there will still be volatility. And what about sales? Sales will bounce back. We expect it to bounce back by over 20%. But the key is still about supply. We are hoping that supply will free up probably another 10 to 20%, and hopefully that will help sales, help to boost up sales. But tight supply will also push prices up. We expect a 5 or 6% increase in price overall in the state. These are the factors: rising insurance costs, political turmoil, geopolitical tensions, and of course, uncertainty in the CRE sectors. Those are the risks that could actually derail or have an impact on 2024. Now, the last three slides, these are things that you can find on CAR website: fire insurance one pager, Smart Zone. That's the website that you can take a look at on our website. Has a lot of statistics. And then the Realtors Resiliency Package. If you haven't heard of it, if you're interested in getting 3 free classes, that's where you'll see find some information. With that, I am going to turn it back to Anthony for any Q&A if we have time.
Great. Thank you so much, Oscar. I took so many notes. I mean, some of the highlights I think that are really important for realtors to take note of are home sales were down 25% last year. First-time buyers make up 36% of the market. So it's a great strategy for us to focus on first-time buyer seminars. A third of first-time buyers are getting help from their parents. The average time that people are spending in their home is 12 years, which has gone up. I've taught classes on how to work your database for years, and for so long, the average was 6 to 7%. So this is almost double. So for people who are building business through their database, that means that only half the amount of people in their database may be selling this year as compared to years in the past. So you have to either build your database or focus on other ways of bringing in business to maintain it. An interesting thing was, why are people not moving up in their homes right now? The top 3 reasons, well, obviously we know mortgage rates, right? The second reason you said was retiring in their home. And the third one was property taxes. So a lot of sellers who are moving up, they may be over 55. And if they are, it's our job as realtors to make sure they're aware of Prop 19, that they're able to transfer that property tax base. So if that's the number 3 reason, that's a huge red flag for me to be like, hey, we as realtors aren't doing our job to make sure that sellers know about that. Home values were up 6.4% last year. Sales price ratio, right? Things were selling at 99.7% of the list price. Our buyers need to know that. If you're looking for those city stats, they're great for social media. Just log into CAR and you can search that through the 360 industry 360 tab. I do use those. And then lastly, if CPI gets to 2.5 sometime this year, like you said, maybe by the end of the year, we could be seeing rates at 5.5 to 5.75. And that's when I think inventory will start to loosen up and we will see our business start to pick up. So if anyone has any other questions, please feel free to ask. This was super informative. I'll make sure to email everybody my bullet points of things that I took away from this session and share that with you. But if anyone has any questions, please unmute yourself and raise your hand and ask them. Is there anyone?
Anthony, just want to thank you and the speaker. I forgot the gentleman's name for a wonderful presentation. So much great information. This is Jimmy Martinez, by the way, and I'm always just so impressed by you, Anthony, how you're such a leader and how much you give to the real estate community with your knowledge and expertise and helping us agents become better. So I just want to thank you.
Thank you, Jimmy. Always a pleasure to have you join us. Okay, any other questions? If you have anything, feel free to email me and we'll find out. We'll get your answers to you. But again, thank you so much, Oscar. We really appreciate you. Everybody have a great rest of the month of January. We're almost to February, and I think it's going to be a better year for us. Like you said, we're expecting home sales to be up 25% from, or 20 to 25% up from what they were last year. That's definitely good news. We need it higher than that to make up for our losses the last few years, but hang in there, guys, and I'm here to help you build your business any way I can. So thank you so much for joining and have a great afternoon.
Thank you.